Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to take a look at RH. This is a company that just had their second quarter earnings a few days ago. They weren't very good and the guidance wasn't exactly super stellar. It's just a continuation of a downturn in their business. So the stock responded with a bit of a down day. The stock was down quite a bit from 368 down to about 310 as of last close on September 8th. The stock is still up quite a bit, up over 17% over the last 3 months, 18% over the last year. If you go back further out, it's slightly less up, 2% over the last 3 years, but 5 years out, 175% over the 5 years, 401% over the last 10 years. So it's been a very stellar return for holders of RH. And RH is a company that used to be known as Restoration Hardware. They are an upscale American home furnishing company that started in California, continues to be HQ'd in California. They do their merchandising sales through a lot of their retail stores on the catalog side and even online. And they open these large scale retail stores that they feel more like experiences of their stores. They call them galleries. They open in large, often historical buildings. For example, in Boston, it's in the former Museum of Natural History. In London, they just bought a 73-acre estate that they opened up. Well, this is technically outside of London, but it's in the London area. And they do a good job of kind of mixing that experience side of things with just buying furniture. A lot of these higher end galleries have restaurants in them. They're more than just a place to visit for an hour. They're a place to visit for a couple of hours, to eat lunch at, to eat dinner at, while you explore and buy, $20,000 furniture. And recently, RH, formerly Restoration Hardware, they kind of started expanding into the hospitality side of things. I already mentioned the restaurants, but they also have other stuff that I'll talk about soon. And these guys started as Restoration Hardware because the founder in the late 70s was restoring a Victorian home and he was having trouble finding high quality hardware fixtures for that old style of home. And this is where that came from. The focus changed more recently, sort of in that upscale home luxury area in the last couple of decades, maybe the last decade or so. And they are famous, I suppose, in this higher end space for sending out what they call source books, which is their catalogs. And these things are absolutely massive. They are, 1,000 pages, sometimes full color, cost a lot of money to print, weigh 10 to 15 pounds. I think the 2014 catalog weighed something like 17 pounds and had over 3,000 pages. So they've been criticized a bit for the waste of paper that they do. You can obviously get those source books online and you can look at what they look like here. They're basically 600 pages of all of their stuff, and they send these to former customers, to design firms, etc., in order to, hey, look at our stuff, look at our new collections, buy our stuff. And you can kind of see the sort of stuff they offer. Hey, you want a chandelier? Sure, here you go, buddy. It's a beautiful chandelier that has taken forever to load. But I think that chandelier is something like $15,000 if you remember. They do have a membership program where you pay $150 annually, but you get access to discounts of 25% and other services like a private concierge. So you can kind of see, hey, this is the stuff that RH is known for. It's a nice chandelier, I suppose. It's $19,500 if you're a regular, or 14,695 if you remember. That's regular price, not if you're like regular. So let's take a quick look at their earnings. They weren't very good, like I said. Q2 net revenues of 800 million. That's up against almost 1 billion in the year prior period. Q2 gross margins down about 5%. Q2 operating margins down about 5%. Q2 net income down about $50 million. Q2 EPS of 336 versus 454 last year. So certainly down. That wasn't unexpected though. They guided for that. What was unexpected was some of their guidance into Q3 and Q4. So they had those revenues that exceeded their guidance for the second quarter. But a lot of that was from a revenue benefit from faster than expected deliveries and shifting some costs from Q2 to Q3. And then they're guiding for the full year guidance of 3.04 billion to 3.1 billion versus the prior outlook that was in that same range, except going higher on the lower end, and an operating margin of 14.5% to 15.5%. And we'll see how that compares against historical norms in a second. The other thing they did, which they've been doing a little bit every other year or so, is they bought back a ton of shares. They bought back 3.7 million shares in the second quarter at an average price of 325. That's 17% of the total company. So they have been buying back a good deal of the company back from all the way back to 2017. So they're a much smaller company from a number of shares outstanding than they used to be. That's been a strategy of their management. If they feel like the stock is undervalued on a long-term basis, they'll buy back shares. They don't necessarily have a regular buyback program. They might have it in place, but they might not use it. So they buy back strategically like they did in 2017 and like they did recently. So if you're a shareholder, you own a bigger portion of the company than you used to. And like I said, they are mailing out another interior source book. This one's only 604 pages. And that's a lot of their business, right? They sent a lot of that stuff to design companies, etc. Not only to consumers. If you are just a single person, you can order this online if you want a huge book to arrive at your home. But you can also just look at it online like I did. And the interesting thing is this company just used to be a furniture company. Restoration Hardware is their name, used to be their name, but now they are moving into this global luxury brand, essentially. That's kind of their idea. I don't know how this is going to work out, but they are moving past the furniture or only furniture into other spots. So for example, they opened a hotel in New York a couple of years ago. It's called RH Guest House, where you can go there and it's kind of like an apartment hotel mix, very high end, obviously stocked with RH furniture. It starts at $2,000 a night up to $15,000 a night. Don't know how well that's going because they don't necessarily talk about that part of the business because it's so small just yet. But I think they're going to do more of that going forward, and that's kind of the question mark for investors. They're also expanding globally. For example, they introduced RH to the United Kingdom, which is kind of their first international opening. And they did this in an estate outside of London, about an hour and a half outside of London. It's a 73-acre estate. You can kind of see it's this massive thing that they bought, redid. It's in the Cotswolds. A lot of rich people live there. That's kind of their MO. We are going to open these galleries, these large showrooms of our stuff in areas where rich people live. We are also going to do a big opening for them, so attract international press. And that was kind of the idea with this location. It's not necessarily a location that people are going to go to on an everyday basis because it's, in the middle of nowhere, an hour and a half outside of London. But it's a place that people are going to make a trip to, that they're going to get a lot of press on. And it's like, hey, we're going international. Look at us. We're fancy because we own this massive estate. On top of that, they also have a hospitality business that's starting to grow. They have 15 restaurants already or something in that range. And this RH England location, for example, has 3 additional restaurants within it and a place that orders, and a juicery as well, where you can make fresh to order juices and grilled baguettes and stuff like that. So certainly a different business model from a regular furniture store focused on the high-end customer, but struggling at the moment. Beyond that, they also made an announcement that, hey, we are going to expand into Aspen a couple of years ago. And it's kind of a similar thing where we bought 3 separate plots of land in Aspen. We are going to build a luxury hotel there. We're going to build a design gallery there. On top of that, we're going to get into the real estate business where we're going to have 4 or 5 single family homes, luxury homes, obviously filled with RH furniture, and work with local design firms and property management companies to do that and sell those places on top of restaurants and all of that stuff. That was announced in 2019, hasn't really gotten off the ground yet. Maybe some parts are being built, but it's certainly not open in 2023, which is a bit of a problem. They should get on that. And beyond that, with the earnings, they said, hey, we are going to make a proposal for One Ocean Drive in Miami Beach, where this 180,000 square foot site is up for bid, and we're going to invest 150 to 170 million dollars into that. We're going to take a parking lot that's over there. We're going to change it into a 94,000 square foot public park. We're going to add a public sculpture garden. We're going to move all of the parking underground. And on top of that, we're also going to use 16% of the space to add a beach club, to add restaurants, to add a bathhouse and a spa, to add a palm garden and pool terrace, to add hotels, right? To add a design studio, a design library, and other stuff like that. So they're certainly doing luxury, high-end hospitality stuff now. It's not just furniture. And then on top of that, they're expanding into Dusseldorf and Munich later this year, Paris, Brussels, and Madrid for 2024, London, Milan, and Sydney for 2025. They're adding additional US locations. And these aren't just massive, huge design galleries with restaurants and all of that stuff. It's also smaller spots as well. But for the most part, their bread and butter are those design galleries that are like, wow, these are really fancy. These are cool. If you've ever been to one, it is a cool store. But the furniture might not exactly be in everybody's price range. And sometimes that could be a problem, especially when the luxury housing market is going down a little bit. And that's their issue right now. Essentially, they are very much tied at the hip with what the housing market does, right? Because when people buy their furniture, they're doing one of three things. They're moving into a new home, so they're getting new furniture for their new home. They're redecorating, which doesn't happen that often, or they're just replacing one or two pieces of furniture, which again doesn't happen that often. So when there's a bit of a slowdown, especially when it comes to furniture that can cost $20,000 for a chandelier, $10,000 plus for a couch, stuff like that. They do have some cheaper stuff, but essentially it's relatively expensive. That can have an impact on their revenue. So that was the issue with their earnings. The Q3 guidance was 740 to 760 million, and then the problem was that the margins were going to fall to 8 to 10%. That's usually from a historical norm in that 15 to 20% range. So that's a pretty big drop. Again, some of that is shifting the advertising cost of that mail book that they're sending out from Q2 to Q3, and then Q4 earnings are also going to be only 760 to 800 million, with margins in that 14 to 16% range. So slightly better margins, but earnings growth not quite there. They're going to fall in the next year in terms of revenue. So they are shrinking their revenue base, which is a bit of a problem. And then there's a lot of question marks, right? They opened this London location, didn't really say how well it's doing. They said it's kind of promising. We didn't necessarily expect it to be a place where people go to essentially shop on a day-to-day basis. We knew that the majority of the business there was going to be driven by the interior design and trade business, and they're dependent on building those books of business right now, so they haven't really seen that. But it's an hour and a half outside of London, not a lot of foot traffic, not a lot of consumers are going to go there, and those expensive locations, they cost a lot of money to keep up. So if the revenue growth isn't there, that might put pressure on their margins, and this is always a company that has had pretty solid margins. So if that starts to fall off, and if revenue growth isn't there, that could be a problem. So as we look at their price point, like we talked about already, it's been priced pretty well. From a historical multiple valuation, I'm looking at the last 12 months over revenues, and this kind of includes the recent fall. It's obviously lower than it's historically been, but this is kind of during the height of the pandemic boom. So a lot of companies went up quite a bit, and that didn't hold because some of that growth was just pushed forward growth from now, and it didn't continue on, and the market expected it to continue on. But if you kind of go back to the 18 to the 19 range, this is a stock that was kind of in that 1.5 to 2.5x multiple on a sales basis. Now it's trading at a 3.1x, so kind of expensive. If we look at, let's say, earnings per share, remove that, go back to a 5-year basis, certainly a bit more in line with historical norms. It's been cheaper recently, but it's not too bad on an earnings basis, and some of their margins have ticked up in recent years. Even if they're falling a bit right now, they're still kind of better in a lot of ways than the last couple of years prior to the pandemic. They were able to kind of push through some of that pricing, but they did talk about, well, maybe our pricing was a bit too optimistic on one of their earnings calls recently, and they're saying that some of their pricing is going to have to come down to push that growth lever up a little bit. And they kind of said, well, we're at an inflection point in the next couple of quarters where some of that growth that is disappearing, where we're shrinking as a company, is going to flip over to a growth basis again. And if you look at the estimates, that kind of is what the estimates are showing. 2023 actuals were down about 4.5%. 2024 is going to be down quite a bit. That is basically this year, from a fiscal perspective, down 14%, and then returning to growth, but not really getting back to what they had in 2022 until 2027. So you can kind of see why the price is down where it is. And on top of that, there's been some margin pressure Historically, the margins outside of 2018 were in that 6 to 7% range. They ticked up to 13% during the pandemic, where the stock soared. Now they're back down to 6 to 5%, and then maybe going back up again. So, from a valuation perspective, I kind of did my own analysis here, where I think some of these margins, based on what they were saying in the call, if you listen to the earnings call, maybe a bit optimistic going into 24, 25. I think the recovery is going to coincide with the housing recovery. And really, if you think about housing, it doesn't seem like it's even taken a hold just yet. It's starting to move in the downward direction. And maybe on the luxury side, where I'm not really in, I certainly don't own a luxury home. My home's okay, but it's no luxury home. It's starting to kind of move downwards because home prices are still very elevated and interest rates are at, not all-time highs, but they're near 20-year, 30-year highs. And if home prices are 3x what they used to be, and now rates are starting to get to 3x what they used to be, that is a bit of a problem. And rates either have to come down or housing prices have to come down. And if people aren't buying new luxury homes, that is a problem for RH. If the luxury space is kind of slow or dead for a bit, that is a problem for RH. And they're saying the inflection point is going to happen around here when they're going to start getting back to growth. But if it takes longer, this stock could be punished quite a bit off of where it is today. On top of that, you've got this hospitality business that they're moving into. And yeah, they've had restaurants for a couple of years already, maybe even a decade. And those restaurants, apparently, according to some interviews, are doing well. Something like $10 million in revenue per restaurant per year at a profitable level. So as they add more of those, maybe that's a good thing for the business. But how is this luxury hotel stuff going to work? They're spending a bunch of money in Aspen on something that hasn't materialized yet. There's a lot of pushback from some of the locals there in terms of how much of an impact they're going to have. They don't want a company like this potentially moving into their sacred little area. They're doing this One Ocean Drive thing in Miami Beach that's going to cost $150 to $200 million, probably more once all things are done, because things always cost more on the construction side. Who knows if that gets approved, whether that's a good thing, whether it's a bad thing. And they're essentially trying to become a luxury global brand, whereas right now they're more of a furniture United States based company. So their aspirations are something else, something completely different than what they currently are. And that may be a good thing, but the unknowns may be a bad thing for investors. So for me, because of all the unknowns, I would target a better return than I typically target. So I target something like 10 to 12%. Maybe I'll target a 15% return for a company like RH because of all of the unknowns, especially with the housing market, how closely this is tied to the housing market, and how long that recovery may take, and whether or not we're even at the downturn or just starting the downturn. They sort of said, yeah, we are totally already in a recession. We are totally already seeing a downturn in the housing market. And maybe they know better than us, but for me, I just haven't really seen that quite yet. I think it could get a lot worse than it already has. And if that happens, then these projections for 25, 26 could be out the window and their margins could be pressured. The good thing about this business is that it does a pretty good job of converting the revenue into free cash flow, even when things are slowing. So things obviously slowed a bit in 23 and 24. They're still maintaining okay margins despite investing more into the business, despite opening some of those locations, despite sending out those source books and focusing more on that completely new furniture in those source books that started. I think they said something like up to 80% of their stuff is kind of new and fresh. So maybe that'll drive new sales. At least that's the idea there. So I'm assuming, yeah, we're going to fall in 24, slow growth in 25, slower than what this is projecting, and then generally slower growth up to 28. And I'm also not projecting that they're not going to get back to, their 12% margins, 15% margins, 27, 28. I'm sticking at 10. I think that's kind of their realistic path. They're making all of these investments in other areas. Who knows what margins they're going to get out of those areas? But at the end of the day, it's an unknown. So for me, I'm just going to say, listen, you're at 10%, which is closer to the average you had for the last 5 years. Maybe that average is like even 9% or something like that. Yeah, there's been highs in that 13% range, but you're also in that 6 to 7% range half the time as well. So as a company, I think 10% is a realistic target they can hit. And for me, it sort of makes sense. And then on the buyback side, I'm using about 25% of their free cash flow towards buybacks. The one thing you have to worry about as an investor now that you didn't have to worry about before is on the balance sheet. Because they've bought back so many shares, they've taken on a little bit of debt, right? This is a company that used to be basically debt free, and now they have 2 billion plus in debt because they use some of that money to buy back shares, and that could be a bit of a problem as they are now kind of lacking the ammunition to buy back more shares. They do generate some cash, but they're going to have interest payments that are higher now, and they're going to be starting to pay back some of that debt and making some investments into other areas that are not their bread and butter. So that's something to keep in mind. I'm not necessarily worried about their debt. It's still pretty well covered by their debt to EBITDA ratio. It's only, 4x at this point, which is a bit high, but they're going to potentially be able to get that down to a 3x range in the next couple of years, assuming their EBITDA hits up again. But if there is a bit of a slowdown, that could be a bit of a problem. Like 4x is a bit elevated, and that's especially true in relation to their history. And I mean, they used to be in the 4x range in 2017 when they bought some shares. They paid that down pretty quickly to basically be at no debt at all going into 2022, and now they took on additional debt just as there's a slowdown in their business, which could be a bit of a problem, right? If their free cash flow is in that 100 to 200 million range for a while, it doesn't go back to their historical 400 million that they had. It could take a while to pay off that 2 billion in debt. So the hope is that kind of goes back into that 300 million range. They work on paying that debt down. But from a buyback perspective, they bought back almost a billion in shares in 23. Like I said, they bought back a ton of shares, another billion in 24, buying back a huge portion of their business. This is a company that had 24 million shares this time last year. It's down to 18 million shares this year. Some of that was bought at an average price of 250. A good portion, a larger portion of that was bought at an average price of 325. So long term might be a good bet, but in the short term, because the stock price is a bit lower than that now, not ideal. But again, assuming some sort of buyback, and then pricing out some of these scenarios, right now they're getting a 4% free cash flow yield from the marketplace. I think there's some upside here, so I'm giving 10% and 20% to a slightly better free cash flow yield. But then there's also some downside, and I'm kind of pegging it mostly in that 5% free cash flow yield area. And with those scenarios in mind, and a 15% target return, like I said, a higher target return than most because of the uncertainty around this business, how tight it is to home prices and home movement in general, and then all of the other stuff that they're doing, which is kind of weird. They actually own 2 jets as well that you can rent out. That's another thing I didn't mention. They own a yacht that you can rent out. So they have a lot of business lines going on, and they're not really focusing on their main one. Is that going to be a problem for them? Who knows? It could be amazing. This is a company that if they can get their margins right, if you sort of look at higher margins going forward, if they can get back to 13, 14% margins and keep that consistently, if they can get back to growth because some of these areas are paying off because their international expansion is going well, this could be a stock that could be, doubling, tripling, quadrupling in the next couple of years, in the next decade. But there's a lot of uncertainties there that make me a bit wary. But I do quite like the company, which is obviously why I'm reviewing the stock. It's just a reason. It's just a question mark of whether or not I love the price right now. And if your target return, for example, if my target return was 10%, the price is pretty reasonable. It's basically right on top of my fair value is right on top of where we sit today after the fall. There's potentially some upside here, right? If the margins, if they grow faster, let's say the margins get back to 13%, right? You're 30% above your price today at your fair value. It's just all about where your margins are going to rest in the next couple of years. And if they can execute to a point where, hey, yeah, there's an actual inflection point in 24, they start growing again, margins get back to 10%, they really do a good job of developing that Aspen area, the Miami area, if it gets approved, the international expansion goes well, this could be a company that has really, really, really solid returns, even if they're not buying back shares as quickly as they used to, simply because they have all this debt that's overhanging them because they have to pay it off. But for me right now, I think I would need a slightly better price point because my target return is a bit higher on something like this because of the various unknowns and the lack of results in essentially the last year and the next year that is almost baked in, right? They've essentially shrunk 20% off of their pandemic highs, and that's because a lot of that demand was pushed forward. They're not going to reach their pandemic highs in revenue probably until like 2027. Maybe the margins are going to be even lower than that. So it's a company that's sort of not growing for 2 to 3 years. Is that something you really want to own? Maybe the answer for you is yes, if you are more comfortable with a lower return, if you're comfortable with that unknown. But for me, and maybe this is a price that will never happen, I'd want this to be in that $250 range for me to take a larger position. I don't actually own this right now, but maybe if it starts heading south from here and the price gets to 260, 270, I'll take an opening position and kind of build it as it gets lower. But for now, it's not something I would really love. And there's obviously some downside here if I, kind of make it so that the growth is lower, that margins don't really recover. They're in that 7.5% range. It's actually 40% off of where it is today at a 15% return. Even at a 10% return, it's 25% off of where it is today, because the returns you're getting at a free cash flow yield are pretty low, and even at a better free cash flow yield, they're only 11%. So if we go back up here, what's the range in returns? Well, it's 12% if the free cash flow yield stays as it is now, and 7 to 18% if it sort of is in that 3 to 5% range. That's at a 15% target return. Sorry, that doesn't matter. It's at any return, right? So as I look at free values across the fair values across the different free cash flow yields, it's 274 at the current one. It's 364 at 3%, 276 at 4%, 223 at 5%. So if you think that the market's eventually going to replace a lot of stocks to a 5% free cash flow yield, it's the stock is 28% overpriced. So interesting business here, but I think there's just so many weird things going on here. The CEO is an eccentric guy. He's certainly trying to make this into a Louis Vuitton type brand in the long run, and that could have amazing potential, right? If they deliver on making RH a household name in Europe, and continue to grow it domestically, it could have amazing potential. If they can do this hospitality thing correctly, if they continue expanding their furniture business well, if they get back to growth on the furniture side and they start expanding margin, you could have a stock that's a multiple of what it is today. Because at the end of the day, you're getting a 2x multiple, less than a 2x multiple on sales right now, on a pretty good business, a business that generates free cash flow every single year since 2018. Can they weather a recession? I think they'll struggle in a recessionary environment, to be honest. This is a business that is very much tied to the housing market, to the fortunes of the luxury space, not necessarily the uber wealthy, but also just the wealthy, the relatively wealthy, etc. And maybe they're a bit more insulated from a recession in terms of, hey, if my $100 million fortune is down to 50 million, well, it kind of sucks, but I can still probably afford a couch. But as we see now, there's still certainly an impact to their business when the luxury home area slows down. My just main worry here is that it's going to slow down further, and we haven't seen the worst yet. And if we do see more degradation in their margins in another earnings announcement, if we see more degradation in their earnings in another earnings announcement, and they say, well, the inflection point is now 2025 instead of 2024, that longer recovery is going to be a bit of a problem, especially now that they've extended themselves on the debt side. They're going to have some debt issues if they start actually losing money, and they might have to struggle through that, and we'll see how that goes. But for now, for me, this is a bit of a pass unless the price looks a lot better. But if you are more comfortable with a 10% return, if you think this is a great business, I could see why you would be buying this at this range. So, depending on where your target return is, the fair value is anywhere from $250 to $310, right around the price point. But like, even if you want a margin of safety at a 10% target return, which some investors do, kind of gets you back to that $250 range that I had, which to me seems like a good price to buy at. Doesn't mean it's the absolute fair price, the fair value, because this is a combination of various scenarios that I've priced out. It's just a way I look at it. It's something that would make me interested in the business, make it seem like a really good value that I could really take a bite at it then and hope for a good return, because it's more conservative than just looking at it from, well, if I look at it from just the current free cash flow yield, or believing that it should be getting a better free cash flow yield because of what kind of business it is, right? That fair value might be closer to what it is today or even higher. But as you're kind of trending up on that free cash flow yield space, if you're assuming that the market is still giving it a pretty sizable multiple based on their declining revenue and their declining margins, maybe today's price point is a bit too high for you, and maybe you need a bit more. You need a bit more of a return. That's my spot. That's where I am. Let me know what you guys think. As always, guys, thanks for watching. Please leave a like and subscribe if you are new to the channel. Please remember, I am not a qualified financial advisor. Please do your own due diligence before investing in any companies, including RH. But let me know what you think down below. Thanks, and have a good day.